The Singapore real estate market is largely subdued in most of 2014, where buyers and sellers are generally in a stalemate as a result of strict financing regulations. The private residential property market has been steered towards greater stability after the government's implementation of market cooling measures, particularly so the total debt servicing ratio, or the TDSR, which has restricted home buyers' access to credit. Overall, home prices have fallen by 3% in the first 3 quarters of 2014, and rents have weakened by 2.1% during the same period. The high-end luxury segment had been the hardest hit, with average capital values and rents declining in 2014 on the back of weak home buying and leasing demand for such properties. The office sector continues on an upward trend this year, with improving rents and capital values that are supported by returned business confidence and healthy demand from a wider source. Sustained healthy leasing demand supported an increase in the average gross rents of premium and Grade A space in the CBD. Despite the fall in the sales volume for strata title office space due to the TDSR, new benchmark prices had been achieved for the office space in the investment sales market due to better rents. This supported an improvement in the average capital value of premium and Grade A space in the CBD. In the retail sector, although Singapore remains a key retail gateway to Southeast Asia, operators' resistance to rental increases in a highly challenging and competitive trading environment had limited retail rental movements, which had generally remained unchanged in 2014. The premier retail location in Orchard Road also continues to face competition from suburban malls as well as other retail locations. Rents for prime retail space in Orchard Road had thus softened marginally during the year. With investment interest in retail units remaining languid and with overall demand volumes falling due to the effects of the TDSR, capital values of prime retail space in Orchard Road remained flat during the year. In the industrial property sector, on the back of various measures and new policies put in place by the government to ensure that industrial space remained relevant and affordable to industrialists, the performance of the industrial property sector had been mixed in most of 2014, with some segments holding up better than others. According to official numbers, rents of all industrial properties moderated during the year, while prices improved mainly due to demand for costlier freehold properties that are limited in supply. A key challenge for the Singapore real estate market in 2015 will be how the market and industrial players can better adjust to recent policy changes and the continued enforcement of punitive measures. An example is JTC's revised subletting policy, which took effect on 1st October 2014. This is expected to slow down en bloc sale transactions of properties built on JTC land. Along with earlier policy changes, such as an upfront land premium requirement and the revised assignment of lease policy, these are expected to increase the difficulty in executing sale and leaseback transactions in the industrial property sector. This could hurt rents and yields achievable by third-party facility providers in the medium term. Therefore, it is essential that industry players stay nimble and their business strategies be adapted to harness opportunities and manage risks in the highly regulated environment. The private residential property market is expected to continue operating amid a strict financing and regulatory environment, and downside risks are likely to further temper demand for homes and weigh down prices. This is on the back of uncertainties in the global arena, the long-standing threats of an impending interest rate increase, and a looming supply of homes. Nonetheless, home buyers will continue to be attracted to well-located projects in areas with growth potential, particularly for those with enticing price points. This will provide the impetus for developers to price their projects more competitively to drive sales. Consequently, overall home prices are projected to soften by up to 5% in 2015. With the mounting supply of new homes vying for a limited pool of tenants amid a competitive leasing environment due to tightened labour and immigration policies as well as corporate housing budgets, this could exert further downward pressure on rents by up to 3% in 2015. The outlook for the office property market is expected to remain positive in 2015, despite some headwinds in the global economic and political environment. Singapore remains a location for multinational companies looking to set up regional bases. This bodes well for the Singapore office property market. Office space take-up is therefore expected to continue to benefit from a wider source of demand, including the technology and info communications, pharmaceuticals, banking and financial services, insurance, energy and commodities industries. 2015 is expected to see the completion of just over 621,000 square feet of office space. The limited pipeline of new office space in 2015 will therefore continue to favour existing landlords. They are expected to have more bargaining power over tenants competing for a limited stock of space options. This will provide support for rental increases, especially for premium and Grade A office space in the CBD, which could increase further by up to 10% in 2015. Capital values of similar office space in the CBD are expected to continue strengthening by up to 3% in 2015. With ample offerings of quality retail space in various districts, Singapore remains a desirable market for new brands and an attractive destination for international retail operators. Some 1.2 million square feet of new retail space is expected to be completed in 2015. However, the retail environment is challenging due to rising costs, shrinking profits and a tight labour market. Operators are also expected to face increasing competition from the e-commerce industry. Consequently, retail rents are likely to remain flat in the near future. In the strata title sales market for retail units, the TDSR will continue to restrict retail investors' access to credit. Opportunities in this segment are hence expected to be subdued. With demand and transaction volume likely to remain muted, capital values are also expected to continue to trend laterally. In 2015, the industrial sector is expected to perform slower compared to 2014 as new government measures and policies continue to filter through the market. Potential headwinds also include the uncertainties surrounding global economic recovery and the unrest in Iraq. While there will be continued interest and leasing demand from firms in the growth industries, tenants are expected to remain cost-conscious and supply pressures are likely to weigh down on rents. This is particularly the case for the multi-user factory segment, which is expected to see an average of some 3.5 million square feet of new supply per annum from 2015 to 2018. In the strata title industrial sales segment, sales are expected to remain slow unless the price gap between buyers and sellers can be breached. Prices are expected to soften as there is no impetus for any price upside, since buyers are generally price conscious, selective and cautious in their acquisitions.